What was your worst decision which you regret? नहीं करना था कर गए.
And I remember at that time, someone told me, look, it's residential property. You can never go wrong. It was one of my worst decisions. One, because I had no experience in this space before we became an investor. India should be an upper middle income economy. To me, that is the outcome that would make me. Time in the market is more important than timing the market. Today, the entire conversation about trade tariffs and Trump's policies and what does that mean for the world.
Do you consider India an opportunity or it's a worry?
One of the behavioral errors we all make, and this is true not of individuals, but actually the best investment professionals, is I would argue that diversified portfolio actually fits many of those safe criteria better than any single asset class, even if that's real estate.
What are the biggest risks which you think from India market investors should be cautious of? Welcome to CA Unplugged series, where we decode markets, money, and everything in between. I am Jayprakash Agarwal, and today's guest is Manpreet Gill, Chief Investment Officer at Standard Chartered Bank, a truly global Indian who has lived and worked in India, Singapore, and now in UAE. Today, we explore how NRIs can build wealth across borders through market insights, smart financial planning, and a banking network designed for global lives. We will explore everything from personal finance to global market trends and help you make good sense of where to invest and how. Welcome, Manpreet Gill. Today, when I'm sitting here in Standard Chartered Tower, I love the space around. This center looks really great, a good vibe. What exactly this center is all about?
Well, thank you for having me, and thank you for making the way all the way out to our center and our office here today. So this priority private center, it's meant to really be two things, right? I mean, one is, of course, meant to be a calm space for clients to discuss investments with their advisors, but it's also meant to be reflective of Standard Chartered, the heritage of the organization, and the markets we operate in. So, for example, if you look at the meeting rooms, the names of the meeting rooms, they reflect all the key markets we operate in. And if you go into the meeting rooms, you'll find obviously artwork, artifacts, and other characteristics, reflecting those markets. So it's about the heritage of the organization, heritage of those markets, and that we think adds a lot of perspective when you're thinking about investing.
Lovely. How many such centers you have in GCC?
Well, actually, this is the first, and I think hopefully, it should be a great start down the journey of adding that perspective. But you always have to start somewhere, and I think hopefully it goes a long way to sort of telling people more about the Standard Chartered story and really where we come from.
Let me ask you a straight question. You are the Chief Investment Officer of Standard Chartered Bank, but that is today. How has been your journey? Where it started, and how did you reach here?
Well, it's been a long journey, but there were really a few sort of key pivotal decisions that I think now, with the benefit of hindsight, it's easier to see. So look, I was always interested in macroeconomics and financial markets. I think I was lucky to sort of see some of that when I was, in college. But obviously, easier said than done. And I think one of the first sort of decisions that got me in the right direction was I originally started a career in risk analytics. And obviously, when an opportunity came up to move to financial markets, it meant taking a risk very early in your career to shift directions. But I did at the time, and I'm glad I did. This was back in India, where I chose to move to my first employer in Bombay. So that's obviously what got me into financial markets and the investment industry. Now, a second decision, of course, I chose to go away and study. I went to business school at INSEAD. And that, of course, was a decision shaped by a choice between going to continue in a single market, a single country financial market, or look at global markets. And I think that decision obviously helped me move into more of a global markets role. And third, of course, is again, more recently, taking the risk of relocating from Singapore, where I've lived with my family for 14 years. 2.5 years ago, moved out here to Dubai, where clearly, a lot of excitement, a lot of energy. So again, it was almost a third risk that sort of helped me get to, I guess, professionally, my current role. So it's really about, being clear. It was a combination of being clear about where I wanted to go, but also willingness to take a few key risks, being willingness to move locations, along the way. And I think it's that combination, together with a lot of very key mentors along the way. It wouldn't have happened without them.
Do you think that the first decision of the first job helped you to decide that, yes, this is the field where I want to go, or it was always in the head? Because first job you did, and then you moved to the global outlook by taking a business role, business course. Was that the decision, or you don't know? I was very clear, Jay, I want to always do this.
So, I think that first decision was really the key one because it was the easiest thing in the world to say, look, you've got a great career going in risk analytics. Why would you take the risk and start again in something else? And it was a risk because when, I hadn't spent very long in the workplace. So, very early on to be switching roles, switching industries. I remember friends asking me saying, well, how will you explain this a few years later, right? But it was a considered risk, no different from investing, saying, yes, I recognize it's a risk. I think it's a risk worth taking. And I think that really sparked the rest of the journey to say, hey, I took this risk. It worked out. I enjoy what I'm doing. Let's keep going down this path.
Talking about risk and decision and talking about investments, I have seen taking investment decisions are not easy, okay, because there is risk involved. You have been taking risks, you have been making decisions all your life. How about the risk and decision making in Standard Chartered every day with so many investment decisions coming to your plate?
So I think it's about having a strong process in place because to your mind, I mean, it's a number of decisions, an infinite number of outcomes. How do you sort of reduce that to a set of decisions that, an investment team like ours can take? And I think we sort of do it in two ways, right? So one is looking at the investment process itself, right? We are open platform, right? We recognize where we can never be a big enough team to cover all markets and all geographies at the same time. But there are a lot of resources available out there in the marketplace. So whether it's at the point of, looking at investment views, harnessing investment research from across independent research, our own research, asset management, different parts of the industry, we have a process by which we try to harness all of that into our decision-making framework. And that open platform approach carries through, including to the implementation, right? And what that means is helps us simplify how do we make decisions, what do we make decisions on, but it also keeps a focus on the end outcome, saying, look, we're here to make investment decisions to help clients, make investment decisions in their own portfolios. So it's a big focus on the outcome. The other thing we do is that client focus, right? Because it's not just about saying, well, there's a single portfolio and I'm just trying to make a bunch of decisions around it. What we do is sort of put in the framework of what we call today, tomorrow, and forever. So it's really about saying for the average investor, I mean, you need your investment returns today, right? There's a combination of might be a salary and income, might be some investment resources. That's today. But then there might be some tomorrow decisions in there. I have kids who need to go to university. I have a retirement plan, perhaps in a different country. So that's about planning for the tangible tomorrow goals. And then there's a forever. None of us, can live forever, but, our assets can if planned and organized properly. It's really about saying, how do you plan that legacy and make sure you're thinking not only about today, tomorrow, but for the very, very long term. So I think it's about matching that open source investment views and matching it with where, the average investor sits.
I love the thought process of today, tomorrow, and forever. Let me ask you a different question. For when you look at the different investment strategies or decisions, what has been your best decision so far, which you think this was the best decision from investment perspective, maybe falling in the bucket of today, tomorrow, or forever? And when you are answering that, also let me know what was your worst decision which you regret, nahi karna tha kar gaye.
So I think from a best investment decision, obviously that's the part we like to focus on. So there are many we can highlight, but I think, look, actually the best has been one of the simplest, right? If I look back over the last 13 years since I joined Standard Chartered, we've actually taken a view to take a large overweight to global equity markets. And that's even before you start saying, should that be US or China or anything? Just saying equities, bonds, cash, we should hold more equities than usual. And when I look at our investment track record over that period, it's something that has worked out very, very well. And I think why I like it is not only because its contribution in terms of returns, but also because of its simplicity, right? We tend to focus in quite a lot of granularity, but the highest level 30,000-foot decision was one of our best. So I think that would be one of the better ones. In terms of ones that didn't work out, maybe I'll draw on my personal life more than my professional there, right? So very early on, and again, before I made the transition to being a better investor, when you start a career, friends and family obviously advise you that maybe it's time to own a place in which you live in. Why are you renting? And I remember at that time, someone told me, look, it's residential property. You can never go wrong. And as I learned, of course you can go wrong, right? In any investment decision, you can go wrong. But I think it was one of my worst decisions. One, because I had no experience in this space before we became an investor, but also it was a decision made without the process, the thought process, the due diligence, the thinking of different scenarios. What we do now as an organized process, that's why it ended up not being such a great decision.
That's lovely. That means the process is important. If process is important, what is the process which Standard Chartered follows in terms of investment strategy?
So I think in terms of process, I think I'll focus again on what we advise our clients to do, because there's one part of what we do which is more focused on the behavioral finance side, which I'll come to in a moment. But I think when we talk to our clients, what we ask them to focus on are what we call our 5 wealth principles, right? And that's what we try to apply as much as possible when we come to that our own decisions, right? I think number one is what we call discipline, right? Sounds obvious enough,
Yes.
but actually not enough investors, even professionally, apply enough discipline to say, look, are we applying the right process? Are we thinking about the different scenarios properly? Are we staying invested and not responding to emotion or what is the, today's, news top headline of the day, but staying true to a planned investment strategy, right? And I think applying the discipline is number one. Second, of course, is diversification. Doesn't need much explanation, but again, I'm never surprised when I'm always surprised by when I come across portfolios which are not diversified enough. There's a temptation to always say, look, I want to pick my high conviction ideas and limit to those. But the real benefit of diversification is achieving consistency of returns. It's easy to have a fantastic year or a terrible year, but remember, we're all in this for the long run. It's about delivering returns over that long run. Third, of course, is time. We say, look, you might have heard this before, right? Time in the market is more important than timing the market. But again, I think we've realized that's something we need to remind ourselves of constantly, because there's always a huge temptation to time the market. Today, people keep coming to me and saying, look, our market's expensive. Should I wait? Well, that was true 6, 12, 18, 24 months ago. Or it's the end of the world. President Trump's measures are heading us, to recession. Is that the case? I'm not investing. Let me wait for greater clarity. Either extreme is bad, right? And I think that's really the point with time. And then finally, of course, look, risk, right? Risk is about understanding your risk and really saying, look, is the risk worth taking? A bit like my career decisions early on, right? And the last one is actually protection. And that's more thinking about preparing for unexpected outcomes, including today in the today, tomorrow, forever, the forever category. None of us are around forever, but it's not just about generating the wealth, it's also about protecting it. It's sort of the end to end. So I think when we think about wealth and sort of building an investment strategies, these 5 core wealth principles, that's really our guiding factor and what we advise our clients to think about as guiding principles.
Perfect. I love that DDPT, what you have defined in terms of investment strategy. Do you think being global as a Standard Chart helps you to stick to these principles and diversify as well because you're looking at multiple markets, or you think it is restricting you or it is not suiting your strategies as a Standard Chartered? Being global, it is helping or not helping?
No, I think it's incredibly helpful. So one of the behavioral errors we all make, and this is true not of individuals, but actually the best investment professionals, is we tend to have something called a home bias. We tend to invest in either our home market or things we're familiar with, and that's okay. You should understand the risk you take. But at the end of the day, when you think about our wealth hubs for a moment, right, they're all centers that allow investors to invest globally. You're able to take advantage of opportunities around the world in all the major asset classes. And when you go back to those wealth principles, right, about diversifying, about having discipline, about, being invested, taking a global approach really helps avoid a lot of the mistakes about being invested in a single market or a single asset class. So while building knowledge and building that out slowly is important, but when we're talking about diversification in the true sense, it's really about taking advantage of being diversified as widely as possible. And that's where I think our global approach helps, right? And like I said, we do take advantage of the fact that we operate, quite focused in Asia, Middle East, and Africa, and that gives us an edge, and those are areas we focus on. But at the heart of it, we start with the global asset allocation approach because we think that gives you the best starting point and maximizes your chance of achieving that consistency of returns and not getting caught unaware by a single event in a single market. Because to me, good investing is about avoiding those sort of outcomes.
Lovely. One question, and considering the recent times for last 1 year or 1.5 years, the way market is unfolding, whatever decision you do globally, whatever time it is globally, what is the protection you take globally, the markets are not doing that great in terms of globally. What will be your advice to the clients that yes, you have to stick to it and this is momentary, because that creates a panic in the market? What do you suggest in current situation, how exactly it is unfolding in the correct in the global outlook?
So, this is where perspective helps. So I agree with you. If I look at the last 5 years, a lot has happened. But what's interesting is when I go to my Bloomberg, over the last 3 years, over the last 5 years, equities have dramatically outperformed bonds and cash. And I think that perspective is important because, every year we go through the cycle, for example, of putting to an annual outlook and we form our market views and then we worry, we think, what are the risks? And what strikes me, having done this now for decades, is that if at any point in time, there's always a lot to worry about. But as a market investor, what we're trying to say is, okay, there is always a lot to worry about, but there's also a lot of opportunity. How do I balance the two? And the connecting factor for me to say is, okay, what price am I paying for that particular asset class, right? And do I think the positives can outweigh the negatives? Because both will always exist at any point in time when I try to form a view on the market. And I think the reason this perspective is helpful and why we spend so much time studying financial market history is because, actually, a lot of the time markets do okay, even when all this stuff comes out. There is volatility, no doubt, right? But to me, that is part and parcel of investing. It's about avoidance of falling prey to too much volatility and worrying too much in the moment. But that's why we draw back to our wealth principles and why those wealth principles are so important, because the market view is one part of it. But it's natural to worry when you hear of bad news, when markets are volatile. You sort of say, should I sell? While actually you should be buying when markets pull back, right? So you're trying to almost, acknowledge there is emotion. It's normal to be fearful when there's bad news. But I think the purpose of having the plan, the wealth principles, the discipline is really about saying, acknowledge there's emotion. But the important thing is to have a process that helps you make a much better decision and not a decision that's driven by the worries and emotion alone. And take it with perspective, right, of learnings from history where you say, look, a lot has happened, but actually risky assets did fine.
Perfect. Do you consider India an opportunity or it's a worry as a investment market?
No, to us, India is definitely a very interesting long-term opportunity. So I think we published a report a couple of years back, right? And more than markets, I think what we did was we zoomed out and said, look, what's really interesting about India is that if you look at per capita incomes, right? We know India at the moment is sort of a lower middle income country, but at the current pace of economic growth, it's easy to see how in somewhere between 10 to 20 years out, India sort of makes a transition to what the World Bank, by its own definitions, calls an upper middle income economy. Now, part of that is just mathematical. You grow at 5 to 6% a year, you eventually get there. And we know growth doesn't happen in straight lines, right, to the previous question. But I think why that's interesting and why a lot of theoretical organizations draw that line at upper middle income is because you start to see a lot of changes in consumer behavior in terms of level of investment. And as a financial market investor, that looks terribly exciting. Because then you say, okay, I look at countries across East Asia, for example, which have been through that transition before. You can see how that played out as, delivering very strong returns on their equity markets, on corporate earnings, across different sectors like consumer spending. So I think that long-term, what we call that long-term structural growth story, which we hear in the media quite a bit, I think that to me is what is the tangible element of it. It's about growth that continues to deliver to the point where it's upper middle income economy. And that's how it translates to earnings growth and hence stock market returns. I think that's what we're excited about. Now, that is a multi-year long-term story. Obviously, we need to manage cycles along the way. And I think in the short term, look, we still, if sitting here today, if I take a view between now and year end, to us is still a solid core holding. Valuations, yes, a near-term challenge. We all would like them to be a little bit cheaper. But to me, it's about using every pullback in valuations as we experienced, in Q4 and Q1 this year to sort of, add to that. And do that within a globally diversified portfolio. We're excited about India, but our portfolio is not 100% India, right? We equally want to avoid that home bias. In Asia, for example, the big allocation are to Indian equities, but also Chinese and Korean equities. And we balance that with equity markets and other elsewhere. So we think it's about the opportunity in Indian equities balancing with all the other opportunities out there as well.
That is lovely. Where do you see India in 2047? So many things coming across, where do you see what's the number India will be sitting in 2047?
So to me, I'd go back to that per capita conversation. Look, by 2047, if India should be an upper middle income economy, to me, that is the outcome that would make me quite excited and quite happy. Because there are many, many details that go into it, and there are things that will make, obviously, outcomes people will be happy about or not happy about. And obviously, we know at a total GDP level that involves, being amongst the top three to four economies in the world. But I think whether I think in terms of outcome for people's livelihood or I think about outcomes for in financial market investors, I think just crossing that threshold, if we get there, if India gets there before 2047, I think that would be, a fantastic outcome.
Outcome is good. What are the biggest risks which you think from India market investors should be cautious of?
So I think there are several, right? And to your point, look, none of these things in markets or economics happen in a straight line, right? And I think a lot of risk was interesting as when you look at the recent history of financial markets. And I usually say 1994 onwards, when markets were really open to foreign investors, a lot of what has gone wrong for Indian markets has often been because of a global risk rather than an India-specific risk. So when I use that lens, look, we know the geopolitical environment is difficult. But actually markets do okay in most geopolitical, risks, barring the odd one like an oil price shock, which we're not that worried about today. I think the real concern in the short term is inflation. Of all the risks out there, look, we still think, markets will get away with a one-off rise in tariff-related inflation. But in terms of ranking of things that could go wrong, that is the one I'd keep the closest eye on, or at least build some sort of hedge in, because, a renewed bout of inflation can hurt equity market returns for a period of time. And then you need, other parts of the portfolio to help hedge against that, or at least smoothen the journey. So those to me are the top two risks that I keep a watch on. For India specifically, oil prices are often like a third standard risk because we know, higher oil prices can be a big drag on growth. But fortunately today at least, and at least for the next 1 to 2 years, it looks like we're in a world where supply is a lot greater than demand. Energy intensity across the world, including in India, is reducing. So that should help mitigate that risk. Perhaps something we might worry about in 5 years' time, but I think for the next 1 to 2 years, we should be okay on that front.
Perfect. Whenever you talk about economics, I see a bell curve in front of me. That is how I learned economics. One thing you said to me, one decision which went wrong for you was the real estate investment in the residential properties. If I go back again to India and look at the Indian outlook, for some matter, everyone believes that real estate investment is much more safer than equity investment, though equity has given returns for so many years now. How do you change that perspective? What's your view on it, or what you will say to those investors that where exactly they are going wrong because you have gone through the process?
So a great question. And I get asked that one a lot because you're right. I think real estate is something which most individuals start their journey either with equities or real estate. I think the key is to really dig into that word you said is safe. It's a safe investment, right? Quote unquote. And I think I often question saying, well, what do you mean by safe investment? Does it mean that it always goes up in value? Actually, that's not always true. And I can point to enough cities around the world where real estate has actually gone down in value over the years, right? So that's not quite there. Is it sort of a hedge against inflation? Well, yes, there's actually maybe more support on that argument. But again, is that really the main challenge today in a portfolio? Should that be 100% of your allocation in a hedge? Or do you think about how much of my allocation should be in an inflation hedge versus growth assets where you hope to earn a higher return? And I guess that's the third point to say, does safe mean that it's about earning the highest return? And there you could argue that depending on which index you use, many other asset classes like parts of the equity market have done much, much better. So I think it's again about having that perspective to say, okay, real estate, if I just look at it dispassionately, what sort of return should I generally expect? But also what role does it play in a portfolio? Because there's no such thing as the perfect safe or risk hedge asset. Every safe asset, quote unquote, fails in a certain type of outcome. Doesn't mean you shouldn't own it, but it is about going through the due diligence thing. Wait, when you say it's safe, what do you mean? And are there scenarios where you're better off elsewhere? And going back to my real estate example, I remember at the time someone pointed out to me that, look, the rental yield on residential real estate in India is less than your cash deposit. So hang on, why are you doing this? Right. And those are the types of questions to ask. In many cases, there is a good reason. right? You expect your capital gains to be higher. You want the inflation hedge. But I think it's really about digging deeper into that safe word and saying, wait, what does that exactly mean? And am I truly safe by focusing on real estate, or am I safer through diversification? Looking back over decades and decades of financial market data, I would argue that diversified portfolio actually fits many of those safe criteria better than any single asset class, even if that's real estate.
Perfect. What is the world average real estate return which you predict? Somewhere around 5%, or it's lower than that? Because when you talk about against cash deposit, real estate, what exactly the returns globally people can earn?
So I
Average.
think the actual number itself varies quite a bit by market. But if I think about residential real estate, right, leaving aside commercial, listed, all of those things, generally you tend to see long-term returns trend around either the population growth rate or inflation, right? And now you have big cycles around that, right? Because an illiquid asset class, and as we're experiencing in Dubai, you can have big overshoots, you can have big undershoots. But when I think about the long-term return, what I would expect without an additional alpha of some sort, is really about saying, okay, if my inflation rate is 5% in a certain market in that currency, and my population growth rate or wage growth is about there as well, then that's roughly where average real estate return should sit. Now, whether they are higher or lower than cash or bonds, that does vary. Depends on the city, depends on the market. So that's where some due diligence is there. But I think I always find the population, wages, inflation as a good approximation of what to expect over a long period of time.
You talked about diversification. What exactly the model portfolio? I don't want to go specific on the portfolios, but what exactly the model portfolio balance which you will suggest to an investor to balance it out?
So we actually publish these. So if you take a look at our global market outlook, we put that on our website as well. But obviously, you can get it through anyone from the bank. We publish that for different risk profiles. So the numbers do vary, and we often use the example of the middle or the balance allocation. If I looked at our last note, for example, that was approximately 40% to equities, 30% to bonds, and about 25 to 30% between alternatives of different kinds. Now, the exact numbers will vary. If you're a risky investor, that equities number goes up quite a lot. If you're a conservative, that goes closer to zero. But the point is that, these that should give you an idea of what we mean when we say diversification. And within each of those, within equities, for example, about half would be to the US and half to non-US markets. Similarly, within bonds. But where I think they're useful is, look, these are models, right? So they're not meant to be a one size fit all. But when someone sits down with their financial advisor, to me, that is always the best starting point for any conversation. Because the idea is that at least ensures, okay, if I want to say, to your point, a diversified portfolio, that's actually what we mean. And it's okay to start there and say, okay, there's certain situations specific to anyone saying, okay, I don't want to own this or I want to own more of that. That's all right. But at least using that as the starting point, that to me is the most useful way to use that. That's why we publish it and make it so widely available.
How does Standard Chartered come in and help the investors? How investors can take the benefit of so much experience and study, which as Standard Chartered you all are doing? What can be the course of action for an investor?
I think the best course of action is to actually come sit down and have a conversation with someone from Standard Chartered. Because if we go back to where we started today's conversation, right, I think it's about saying, okay, one part is sort of forming a house view, right? And we put a lot of effort into that in terms of being open platform, in terms of applying lessons from behavioral finance so we don't make the emotional errors, and being open platform about how you implement it, about how you sort of follow up with the wealth principles. But I think sitting down with a wealth advisor, starting with the model portfolios, I think that's the best way to take advantage of it. Because the end solution, right, we often tend to think of, tell me product A or fund B or whatever it is, that is almost the last step. But it's actually the conversation before that to say, wait, what am I trying to achieve here with an investment? What sort of decision do I need to take? What does Standard Chartered recommend as a result of all the efforts, right? We're not perfect, but the idea is hopefully we end up with a better outcome than most, and with that focus on what long-term returns come through. Then the eventual answer in terms of how you implement it should hopefully emerge from that conversation. But step one is, if you're thinking about investing, make that phone call, set up the meeting, and have that conversation.
Lovely. I mean, that can be the starting point. Two emotions which in investment market gives me goosebumps. One is fear and second is greed. When an investor comes into you and goes for a model portfolio with Standard Chartered, how you can help controlling those emotional part of fear and greed among those investors when markets are doing bad or good?
Well, a few different ways, right? And actually starts with us at our own investment committee before even the individual investor, right? Because for any investor, natural to have greed when markets are doing well and fear when they go down. But the reason we put behavioral finance as the cornerstone of our investment process is because we think half the game is about not making behavioral mistakes, right? But hopefully going back to a more rational decision making process, we're able to make recommendations based on facts rather than fear or greed alone, right? And that's part of where the whole idea of open platform sourcing many sources of research. We've got a group of people who come from very different investment backgrounds. We've been people who are research analysts, portfolio managers, pure chartists, or quantitative analysts. So we get mix of people who look at markets in completely different ways and hopefully disagree with each other. That's what we're getting at. And we're honest to ourselves in terms of, okay, we made certain calls. How did they perform? So if you go back to Global Market Outlook, not only do we publish model portfolios, but we actually publish how they've done, right? And all of that process, we think, leads to a better outcome than a more traditional single person or following fear or greed alone, right? And I think the second part is obviously when you implement it in a portfolio for an average investor, it's natural to experience those emotions because a fully invested portfolio will do very well in boom markets, and there'll be some volatility and pullbacks when markets come down. That's part and parcel of investing. But I think what we try to do is, with the model portfolios, hopefully help encourage that getting but staying invested. A diversified portfolio, a portfolio that follows a wealth principle, should hopefully be less volatile than the market. We saw that in 2022, for example, when equities and bonds were down over 25% at one point, but model portfolios, diversified portfolios, were down by far less. And third is to really add perspective. One of the biggest antidotes to fear, particularly, is perspective. And I'll give you another example of that, right? It's not only recent, but today the entire conversation about trade tariffs and Trump's policies and what does that mean for the world. Now, the problem is you have to go back well before World War II to get perspective on this, right? You have to go back to the late 1800s, which is when the US last imposed tariffs and had some successes, had some risks. But that perspective is really helpful because what we also learned in that process is actually until the start of World War I, equity markets did okay, right? And I think those are the kind of lessons we want to draw. And it doesn't eliminate greed or fear completely, but perspective really helps sort of say, okay, am I doing this because I'm emotionally greedy or fearful? Or is there a good investment case here? And when you combine it with the discipline and other factors of wealth principles, I think that can really help lean against investing on emotion alone.
Perfect. Does the perspective can be gained through artificial intelligence because AI is the market? Or you think, no, that's human touch or human understanding is required to get that perspective out? Because nowadays, products are coming with AI enabled decision makings that invest in this market, or this should be this is the mix which you should go for. What do you think, AI or a human touch on the perspective side for investment?
A little bit of both, right? And where I'm coming from is, okay, AI is a fantastic tool, but like every technological advancement through history, it can be incredibly helpful or be to your detriment, right? It all comes down to how we use it. Now, again, digging a little deeper, right? Staying with that theme, when we talk about AI, I think it's very important to say, okay, what part of AI or what specific tools are you using and what do they do, right? Now, when it comes to investing, one AI-like tool that we've used now for several years is machine learning. So a lot of our asset allocation, quantitative models, our short-term technical models, they're driven by machine learning models at the background, right? But the thing is, we treat them for what they are. Some of the performance is really good, and where the signals are powerful, we put them to use in our investment committee. But we reckon at the end of the day, they are a quantitative tool, an advanced quantitative tool, which can function up to a point, but market regimes can change, especially if everyone starts looking at markets the same way. Again, some professional investors might remember the 1990s when there was a lot of excitement about the quants and quantitative models. They worked really well till they spectacularly didn't. So I think to me, AI is no different to say, okay, there are certain elements of that can really help with investment decision-making. The wonderful thing about models is that they're factual, right? They simply tell you, well, you gave me this macroeconomic and market input. Here's the investment decision that appears to make sense. Zero emotion. Doesn't mean it's right all the time, but it gives you one great starting point to really, as an investor, think, okay, a dispassionate model is telling me this. How much do I agree with it? How much do I not disagree with it when I think about the future? So it can be a great tool, but there's no silver bullet.
Does it happen during COVID? Because COVID was all of a sudden. So was the AI machine learning tools helpful, or there the human touch came in and then you decided allocations for investor markets?
No, I think that's a great example, right? Because a model would take time to adjust to the sudden sharp change of direction. And you have to go back quite a long way to find, pandemics and their impact on markets. And there's no real comparable point in history, right? So it's a good example of where a purely historical data-driven approach, which is what any AI or model will tell you, may not have worked as well. And what we saw during the time is, look, some of our short-term models, they take time to adjust to any change in market regime. But what was unique about the COVID sell-off, it was a very rapid and short-lived sell-off and an equally rapid rebound. With the benefit of hindsight, the best decision was to do absolutely nothing and just stay invested. It did not feel like that during the time, as we all know too well. But I think that's where having a mix of, okay, what's a dispassionate model telling us? We had an understanding of what goes into it, saying, okay, how do I interpret what's coming out of a model and match it with what I'm seeing? And we matched it with also forward-looking scenario analysis to say, okay, we can see this going a couple of different ways. So how do we balance that with, forward-looking scenario planning? And if memory serves right, at the time, we didn't make too many changes. And part of it was, obviously, the time horizon was extremely short. But I think that's where being a little bit patient and thinking through a decision really paid off.
Wow. Very serious talk. Now let me have some fun element with you. I'll say a word or a phrase. You give me first thing which comes in your head.
All
It
right.
can be a single word, a phrase, whatever it comes.
Okay.
Let's start. And it has to be rapid. Yeah. Bitcoin.
Speculative.
Passive investing.
Market exposure.
India in 2030.
Upper middle income economy.
Perfect. Warren Buffett.
Back to basics.
Back to basics. I love that. Risk.
Return.
Oh, Dubai real estate.
Frothy.
Robo advisors.
Fantastic tool.
ESG.
Nuts and bolts at the back of every model.
You see yourself in 5 years.
Still giving solid financial advice.
Oh, that was rapid. And that's what you do. You take decisions very fast, Manpreet. Let me ask you one more question. And whether they are salaried employees or entrepreneurs, what are the smartest way they can invest in? One, they can call your wealth advisors and understand from them. But if they want to start their own journey, what will you recommend them? Working professionals and salaried class.
Sure. So I think the best thing they can do is maybe take a look at our own wealth principles and sort of think about how do they put them to work for themselves, right? Because wealth principles at one level, you could say, okay, they're, some standard tools and ways of thinking. But actually the first one or two can be really useful when starting down, a journey on one's own. Because we start with the idea of discipline and diversification. Now, leave aside diversification, we all know how to do that, right? But discipline, the number one thing of discipline is forming a plan. And for anyone starting on their own, even if they don't have a conversation with an advisor, sitting down and saying, what's my plan? Am I trying to invest for the next 6 months? Am I trying to invest for the next 10 years? Is there a specific goal I'm investing in? Am I trying to beat inflation? Am I just trying to earn a positive return? The answer will always be different. But really sitting down and saying, what is that goal? What is that North Star? I think is the best thing anyone can do for themselves. Because to me, once that is sort of set in stone, a lot of other decisions then become much easier to make. Right? Does this make sense? Does this not make sense? You sort of go back to that North Star. And look, goals change. And maybe, set in stone was the wrong phrase. I think these goals will change as one's life changes, family evolves, and that is okay. But where these goals become really useful is you see, potentially great investment. You see markets that are volatile. You start to think, should, option A or option B. I think continuously coming back to that goal is incredibly helpful. And why we put it right at the start of our wealth principles, because everything revolves around that, right? And a lot of other decisions follow from that and become much, much easier. I think to me, that would be the single most important place to start, not jumping to the end solution of, hey, I found a great investment, let me go put some money behind it. Because my question always is, okay, it's great, stand alone, but what's its purpose? What's it meant to do? And why do you own it? Right? To me, that means going back to the goal and saying, based on the goal, what does a ideal portfolio look like for me? How much volatility am I really genuinely comfortable accepting? And hence, okay, now I can go out and look for ways to implement my plans.
Perfect. I have seen people who have a goal to achieve, but they have a fear of the markets, or the fear which is inbuilt. What is your advice to them? How to tame that fear and come up and start investing, because that is for their goal to be achieved.
Sure. I think that's where, again, the discipline can really play a big role, right? And discipline applied in a very different sense. So maybe I'll reach for one example that we use quite a bit. We give three sort of different examples of ways people can get around that depending on their own sort of personality, right? There's almost one is an automatic route. I'm going to invest a certain amount of every month, regardless of where markets are, up, down, sunny or cloudy, doesn't matter. And that's the simplest approach. We know, the systematic monthly investing, but it's more powerful than we appreciate, especially getting around that inertia and fear about, should I invest now, all of it now, what if markets go down? That's sort of a systematic process that you're forced to follow. Now, a second one is possibly a variation of that, what we call a shopping cart process. It's sort of saying, that's at the other extreme where you say, okay, I know what I want to buy. All I need is, an interesting price level to enter. But you define all of these upfront so that if markets fall to that point, you don't worry about whether markets might fall more or, is it the end of the world? Is Trump going to change everything? You simply say, look, there's a bunch of asset classes I wanted to buy. They've reached valuation or price level or however else you defined it, and I'm going to pull the trigger, right? You set the rules up front, and then you're just executing. Again, you're taking the emotion and the news headlines out of the equation. And the third is somewhere in the middle, what we call a thermostat approach, right? So think of like a thermostat or a light dimmer, right? Where you're really trying to say, okay, as markets get cheaper, I'm going to keep adding more. As markets become more expensive, I'm going to slow down my purchases. So it's a variation of the automatic investment, but adds an element of if you want to be more active about it and say, okay, I'd rather make sure I'm buying more as markets are going down because I'm buying it cheaper. And I want to buy less as markets go up, or at least as valuations become more expensive. It's a variation, but it still makes sure that some amount gets invested at a regular interval and you have a little bit of control around it. The common theme around all three is that it's discipline, a very specific implementation plan, which once you put in place, then you just focus on execution.
Perfect. I love that thought process. One last question. From your investment decisions which you have made throughout your life, as Standard Chartered, whatever decisions you are making, and that is directly to this camera, you can look and talk to your investors. 3 golden rules which you want to say to them, other than discipline and diversification, which I have already learned. 3 golden rules for them if they are going for investment journey, what they should always remember.
So I would say number one, I think, is invest based on a dispassionate analysis rather than emotion. So do everything you can to get around the biases we all know we have. Right, that would be number one thing. Second would be, have a good understanding of what you're investing in, or at least seek to build an understanding where you don't have it, so you're not investing blind. And third, frankly, get a financial advisor, right? And I mean that one not just in jest, but even for investment professionals like myself, advisors can play very different roles. In some cases, they might help with the decision making, forming a plan. Sometimes they just help with the execution. Right. And one of the most insightful articles I read about this was an article, I think, by someone who works as a portfolio manager in one of the world's largest firms. He said financial professionals are the people who need advisors the most. It's not because they don't know what to do, but we're busy. We have day jobs. We have families. Sometimes you need someone to just call you up and say, it's the end of the quarter. You said you'd invest. Why haven't you? We need to set up a meeting. And that, even something as simple as that, can provide a tremendous amount of value.
I love that thought, and I always say jack of all trades never work. Go to the specialist, take that advice and do it. Thank you, Manpreet. I know how busy you are, but still taking out time for us and be here. Thank you very much for your time. And I'm looking forward for meeting you again on another podcast with another knowledge series. Thank you.
No, thank you so much for having me. And look forward to being on this again.
Thank you. That's a great note to end on. A huge thank you to Manpreet Gill for the insights, clarity, and energy. To our listeners, if you enjoyed this episode, don't forget to like, share, and subscribe to ICAI Unplugged. We would also love to hear from you. Drop your thoughts in the comments and let us know what your questions or perspectives you have on today's discussion. Who knows, your question might just shape our next episode. If you have any ideas, also put it in the comments section. Until that time, see you. Bye.